4 straight days of green in the S&P 500 as everybody and their mother is talking about this, the Zweig breadth thrust indicator. What the hell is it? Is it even important? Is it accurate? Let me move my fat head out of the way and show you what this says here. But basically, 6 months to a year later, when this indicator pops up, we are green every single time. Could this indicate that the bottom for the S&P 500 was already put in? And the S&P 500 is down 10% from all-time highs, meaning it's still in correction territory, yet my portfolio is basically back to all-time highs. I've been very transparent with you about my moves in this market, when I was looking to take profit, when I was looking to get back in the market, what stocks I was buying, and recently our purchases on Tesla at 220, on Google below 150, on Apple in the 170s, all of that has been paying off. So I want to help you guys. Let's determine what are the probabilities that this is the bottom here and what should be your game plan going forward. Let's get right into it. All right, so the Zweig breadth thrust indicator, what does this say? In very basic terms, what this means is that less than 40% of S&P 500 stocks were advancing or rallying, with a quick shift within 10 days to over 61.5% of the stocks in the S&P 500 were advancing. So it is basically a thrust indicator, meaning it is a momentum indicator. Now, my personal opinion before we dive into the data and try to ascertain whether this is the bottom for the market, as I told you, do not put your destiny in someone else's hands. Definitely don't put your destiny in the news headlines' hands. When we see certain stocks that are just too cheap to pass up, right? When Google is down over 30%, when Amazon is trading at 15 times cash flow, down 30%, when some of these stocks' market caps are so depressed that their actual cash flow represents 10% of their market cap, as I showed you in the last video, you cannot pass up on that opportunity. I don't care what the hell is going on in the market. So we certainly don't need these indicators to tell us when to buy. Okay, that aside, let me digest this information for you, and let's go back and look at all the times that the Zweig breadth thrust indicator was actually triggered and what that meant for the market. First, it's important to note that so many more people have entered the market after the pandemic than before. This is not a coincidence that this Zweig breadth thrust indicator has been triggered more times within the last 5 to 6 years than it has in the previous decades. Real quick, I'm gonna get it out of the way and tell you that this does not necessarily indicate the bottom, meaning just because this indicator was triggered yesterday on April 24th, it doesn't mean that April 24th is the bottom. We have a very recent example here when it was triggered back in August. It was triggered on August 19th. And you can see that the market actually fell 4% thereafter. A very interesting trigger was January 7th, 2019. January 7th is right here. This was the bottom of the first trade war of the first Trump administration when we dropped almost 20%. Very similarly to now, you could see that we actually put in the real bottom before, and then we started rallying and we put in the Zweig breadth thrust indicator notification on January 7th. It's very similar to now where we have this V-shaped potential bottom. I'll get into that in a second, right? And the breadth thrust indicator was highlighted here. So we actually went on to rally in 2019 all the way until February 2020. And then you know what happened after that. So March 2020, we put in a lower low than that January 9th, 2019. We actually put in a lower low than all of 2019 altogether. Now, this here was indicated as a recession, obviously because we had the pandemic as well. And I'll take you back to one more time in October of 2015, we had a double dip correction. This was due to potential scare coming out of Asia, a global slowdown. October 2015 was right here. And then we just did a double dip correction and put in new lows. So the quick point is it does not necessarily determine the lows, and it does not necessarily mean that we won't see a new low at some point. What it does mean, however, is that it is actual momentum. And I had this conversation with some people in the Traveling Trader Discord, and they were sort of in disbelief that the market could spring back up, right? If it springs back up to all-time highs, they were sort of in disbelief that the market can do that. And what I was saying is there is so much money in the stock market, and it's not necessarily our money, right? Most stocks aren't owned by most people. Institutions need to put their money somewhere, and they need confidence in order to do that. So when confidence is completely in tatters, and then because of maybe headlines, some renewed optimism from earnings, you start to see some inflows pour into the market. Sentiment begets sentiment, and obviously it's monkey see, monkey do. Institutions see other institutions pouring money in, and that's how you get these bread thrust indicators where you go from less than 40% of the stocks in the S&P 500 advancing to over 61.5% within a 10-day period. Now, remember that we hit this death cross here in the S&P 500. What did I tell you last video? And I actually discovered it in real time while doing the video. I said that every single time the death cross is retested, whether we tend to see a decline from there or whether we ignore the death cross and just make a new all-time high, which both cases have happened. In a bear market, obviously, the death cross is retested and then we continue further down. In a correction, the death cross is retested, you might see a reaction, and then we continue up. But either way, my base case was that the death cross would be retested and that we would retest this gap here. This is the Liberation Day gap, April 2nd, when the tariffs were announced. And this is the gap that was left. And you guys know that that was my base case, that we would retest that. This also happens to be the area where the 300-day moving average, this blue line, is. It is also 0.5 of this entire move where we tend to see potential reactions. Obviously, most of this optimism was fueled by headlines, and headline-fueled markets are not generally healthy. But so much was priced in. We haven't seen a fall like this since the pandemic, where we barely have any retracements. If you go back and look at the pandemic, you'll see here, it was just a drop. So much pessimism was front-loaded here that it does make sense because of optimistic headlines. We see some sort of retracement. So we had the 90-day tariff pause, and then we had the relaxed tariffs on China. And supposedly now, the messaging from Bessent is that we are going to see some progress from the China talks. And Bessent himself said that the status quo on China was unsustainable. Now, mark my words, Bessent is not speaking as a free agent here. He would not be able to say this if he did not get a pass from the White House. So obviously Trump is seen as the bad cop. Bessent is seen as the good cop, but they obviously gave him carte blanche in order to say this, right? They saw what happened with bond yields. We've discussed this on this channel multiple times, but if you look at the 10-year yield before that 90-day pause, where it was an obvious Trump put, there was panic there. Yields were spiking and the 10-year was moving towards 5. The 30-year did hit 5. So that cooling off, you could start to see a tamping down of yields, which is what they want. And this was a news story from yesterday saying that Bessent says he wants treasury yields down. So my honest opinion on whether this is the bottom of the stock market or not, my honest to God opinion, you guys know I'm 100% honest with you, is it is likely possible for the foreseeable future that this right here was the bottom of the stock market. Because as I told you guys, once the White House, what did I tell you guys? Once the White House signals that their fight is over, that is when the stock market will be given free rein to rally. Now, yields haven't come down anywhere near where they want them to. But I don't think that they're going to tackle yields by trying to sow chaos in the economy and be aggressive with tariffs, because they saw that, okay, that might have worked initially, but then it stopped working and it actually had a rubber band effect the other way. So what are they going to do? Well, as I suspected, there will come a time when money printing will likely ensue. And by money printing, I don't mean giving stimulus to everyone. I mean that the Treasury will institute buybacks. The Treasury will reduce their issuance, right? They will limit the number of bonds that they issue. Government spending obviously has to be cut because they can't greenlight government spending without issuing more debt. And the Fed already said that if need be, they can step in and improve the liquidity of the Treasury market. So I think that they're going to go about this a completely different way than being antagonistic with the world regarding tariffs. Now, before I tell you what I think the game plan is, this leaves one big thing on the table. GDP. So right now, the Fed of Atlanta is forecasting a negative GDP at negative 2.5%. Now, the New York Fed uses a completely different forecast This is called GDP Now. This is called GDP Nowcast. The Fed GDP Nowcast, the Fed of New York GDP Nowcast is projecting a positive 2.63% GDP. I looked historically on who's been more accurate, and the Atlanta Fed has definitely been more accurate than the New York Fed. And I also stated in a previous video that when the Atlanta Fed has forecast a negative GDP, it has never come out positive. The opposite has happened. They have forecast a positive GDP that has come out negative, but never negative that comes out positive. That's never happened. Obviously, first time for everything, could happen. Anything's possible, but I'm just giving you the history and the data. So a scenario that I could see here is similar to what happened in 2019. And obviously, policy, all this is subject to change depending on policy. I don't work for the White House. This is why I said, don't put your destiny in the hands of anybody else. You see an opportunity in front of you, you snatch that shit up. But I could see a situation in which the market ends up rallying. And then at some point down the line, whether it's Q3, Q4 of this year, we end up seeing recessionary signs. Now, I still think all the data that I shared with you regarding what happens when we see a volatility crush similar to what we saw, the Zweig breadth indicator 1 year later, I still think the market is going to be higher a year later than it is today. But I don't think we are out of the woods where you make a V-shaped recovery and then it's just smooth sailing forever. Now, in terms of your game plan, I told you this before, do not buy on green days, right? If you did not buy when I was screaming and hollering about some of these stocks, Meta, Google, Amazon, you don't want to chase price here. What you want to do is you want to wait for retracements, right? Because this is not going to go straight up. I actually think that from this level, as I told you guys before, I do expect some kind of retracement after filling the Liberation Day gap. We have a gap that we left unfilled here between 5,300 and 5,350. We could come back down to this level. And it is at that point that if you wanted to buy certain stocks and you agreed with the valuations, that's when you should be adding on red days, not on FOMO days when you completely missed the boat. And now you're buying Tesla at 290 when you could have got it at 220, or when you could possibly get it in a few days at 270 or 260. So in conclusion, I do think we see a pullback from here soon. I do think it's completely plausible for the near future that this was the bottom. I don't think the recession fears are out of the woods at all. I do think it's possible to eventually make a new bottom like we saw in 2020 and still be higher a year later after this Zweig breadth thrust indicator was triggered. A 2015 type scenario is also possible where we have a double dip correction before recovering. And in terms of valuations, I would not be scared to buy your favorite stocks here. I'll go over this more in our video on Sunday, but the forward PE ratio for the S&P 500 finally hit around 18. This was something that if you watch my previous videos, I was waiting for the forward valuations to get around the 10-year average for the S&P 500 forward PE. This is the price of the S&P 500 divided by the forward earnings of the entire S&P 500 index. So right now, the S&P 500 is fairly priced. Anyway, quick little video. Everyone and their mom was talking about this Zweig breadth thrust indicator. So I wanted to make a video breaking it all down for you so that you are not in FOMO and panic. If you've been doing your job and you've been watching these videos, then you did pick up some of your favorite stocks at rare levels, and you caught that monster gold short from the previous videos. But if you want to trade live with me every day, you want to get all of my write-ups in real time, you want to get all of my stock picks in real time, which stocks did I buy on the dip, make sure you sign up below. You are doing yourself a disservice if you don't, and you're interested in this stuff, in my opinion. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace. And I'm sure you guys may have noticed, but I switched over to using Public for my investing as well as my option swing trades and selling cash secured puts. It's a regulated broker based here in the US. Now, the reason that I like it over other trading and investing apps is because not only are the options trades commission free, there are no commissions or no contract fees for options trades, but you also get a rebate for stock and ETF options trades. The rebate means that options trades are not only free, but you also earn money. They are less than zero. Now, the rebate is based on your monthly trading volume, so the more you trade, the higher your rebate is per trade. And for any cash that I'm not using, I could just throw it into a high yield cash account that they have and earn 4.1% on my money.